Right now, as you're watching this video, oil has crossed $110 a barrel. Stock markets around the world are bleeding. Japan's Nikkei just crashed 5%. And everyone on Wall Street is staring at their screens asking the same question. Is this the moment the whole thing finally breaks? But here's what nobody is talking about. This isn't random. This isn't just a war. This is the exact same movie we watched play out 50 years ago. Same script, same ending, just different actors. And if history is about to repeat itself, the investors who don't understand what happened in 1973 are about to get absolutely wrecked. Stay with me, because what I'm about to show you changes how you look at this market forever. It's 1972. America just won World War II, put men on the moon, and the economy has been on a 20-year sugar rush. People have money, people have confidence, and most dangerously, people have blind optimism. Sound familiar? Out of this optimism came a brand new investing philosophy. It was called buying one decision stocks. The idea was dead simple. Just find the biggest, most powerful companies in America, companies so dominant you'd never have to worry about them, and just buy them. Never sell, just hold forever. These stocks became known as the Nifty 50. And we're not talking about sketchy little penny stocks. We're talking about Coca-Cola, McDonald's, American Express, Xerox, the blue chips, the untouchables. Investors looked at these companies and said, there's no way these ever go down. And that attitude, that right there, is where the story turns dark. When everyone agrees something is a can't-lose investment, the price goes to the moon. Not because the business is worth it, but because nobody wants to sell. By 1972, the average PE ratio for the overall stock market was 15. Perfectly normal. Nothing crazy. But the Nifty 50? These untouchable companies were trading at levels that should have been illegal. Coca-Cola was at 46 times earnings. Xerox was at 49 times. McDonald's, 86 times earnings. Polaroid was at 90 times earnings. The average across the whole Nifty 50 group was 42 times earnings. And get this, these 50 companies alone made up nearly 45% of the entire US stock market. If that stat makes you uncomfortable, it should, because we are living in the exact same movie right now. Today in March 2026, we have what Wall Street calls the Magnificent Seven. And right now, these 7 companies make up around 36% of the entire S&P 500. Think about that. You put $100 into an S&P 500 index fund and $36 of it automatically goes into just 7 stocks. And just like the Nifty 50 back in the day, investors have been treating these companies like they're bulletproof. Tesla is trading at over 400 times earnings. Nvidia was at 50 times before the recent sell-off. Microsoft at 25 to 38 times. Amazon at 35 times. Apple at 37 times. These are incredible companies. I'm not saying they're frauds, but here's the uncomfortable truth. That's exactly what people said about Polaroid in 1972. That's what they said about Xerox. This company is so dominant, valuation doesn't even matter. It always matters. It just doesn't matter until it does. And here's where 2026 starts rhyming so loudly with 1973 it should terrify you. In 1973, oil prices quadrupled after an Arab oil embargo. Inflation exploded from 3% to over 11%. Unemployment doubled. The gold standard collapsed. And those overpriced stocks, the ones everyone said were bulletproof, they got absolutely obliterated. And the market crashed 50%. Coca-Cola fell 60%. McDonald's fell 70%. Polaroid, the Nvidia of its day, collapsed 90%. And it took 8 full years to recover. Now look at your screen today. On February 28th of this year, the United States and Israel launched joint military strikes on Iran. Within days, oil crossed $80 a barrel, then $100, and at one point last weekend it briefly spiked to nearly $120 a barrel, the highest we've seen since Russia invaded Ukraine in 2022. Just this week, Brent crude is trading around $103 to $110 a barrel. The Strait of Hormuz, the tiny waterway that handles 20% of the entire world's oil supply, is effectively shut. Tankers aren't passing through. Qatar has already declared force majeure on its gas exports. Saudi Aramco's massive Ras Tanura refinery has closed after attacks. Gas prices at the pump in the US have already jumped over 40 cents in a single week. This isn't a small shock. This is the oil crisis of 1973 in real time. And on top of this, the US economy was already walking a tightrope before the first missile was fired. The dominoes were already wobbling. The war just knocked them over. The real danger is what happens when you combine a top-heavy, over-concentrated, overvalued stock market with a genuine macro shock that nobody fully priced in. In 1973, the Nifty 50 wasn't taken down by bad businesses. Coca-Cola was still selling Coke. McDonald's was still flipping burgers. The businesses were fine. But what killed the stocks was the price tag. Investors looked at a stock trading at 90 times earnings and asked, why am I paying that when I can get 8% from a government bond? And the selling started. And once it started, it didn't stop for 8 years. Fast forward to today. If this oil shock is prolonged, if oil stays above $100 for months because the Strait of Hormuz stays dangerous, the Fed cannot cut rates the way the market is hoping for. The Magnificent Seven have already started cracking, and we're only in week 2 of this war. Now look, I'm not here to tell you the sky is falling and sell everything and bury gold in your backyard. That's not what smart investing looks like. Energy stocks are an obvious one. Exxon, Chevron, they're already up while everything else falls. Defense stocks are the same story. Northrop Grumman, Lockheed Martin, already surging this week. Gold has also quietly been climbing as investors run to safe havens. The investors who survived and actually built wealth weren't the ones who panicked and sold everything. So here we are, March 2026. Oil at $110 a barrel. A war in the Middle East with no clear end date. The 1970s call. They want their bubble back. History doesn't repeat perfectly, but it rhymes hard enough to hurt. The 4 most expensive words in investing are still, this time it's different. Don't say I didn't warn you. If this opened your eyes, share it with someone who needs to see it. And if you want to know exactly how I'm positioning my own portfolio right now, drop a comment below. Let's talk about it.